What's up everybody, I am Jaspreet Singh from the MinorityMindset.com, where money minds rethink rich. Everybody has a theory on how you should be spending your money, but it's really interesting when you get to watch it happen firsthand. I was in the gym the other day, and in the free weight area, you have all the weights and then you have benches, and me and my brother were doing curls on one side, and on the other end, you had two guys that were on a bench, they were doing chest, and they were talking, and all I hear is this other guy come up to these two guys and say, "Excuse me, what are you talking about?" I'm probably a good 20-30 feet away and I had no idea what was going on, but now I'm listening and the guy is like, "Were you guys talking about real estate? Man, I'll tell you, back when the 2008 crash happened, I wish I would have bought more properties, and I'm telling you right now, the next crash is gonna be a big one." Now I'm facing a life crisis because I'm between two things that I love. Do I finish my set or do I go hear what this guy's talking about? Well, I did the most logical thing possible. I took my weights over there to hear what was going on. So this guy starts preaching to the other guys about how all this money printing that's going on is causing the value of our dollar to be devalued, and because of that, we're gonna see this massive crash happen, and when that crash happens, we're gonna see asset prices like real estate prices crash like we have never seen before. According to him, it's gonna be way worse than the 2008 crash, and so then he's talking about what he's doing with his money and what everybody else should be doing with their money. He says that he's moved a lot of his money into cash, and he's been buying a lot of cryptocurrencies like Ethereum and Litecoin, and he's been investing a lot of money into energies because according to him, as the dollar gets devalued, the price of energy is going to go up, and so because of that, it is a good time to buy energy. And so he's telling everybody, you need to be buying energy, you got to buy Ethereum right now. These are some pretty fair points, but there's a few things that I want you to understand. First, I'm just a random guy on YouTube. So before you do anything, make sure you always do your own due diligence. And before you listen to a random guy in the gym, same thing, make sure you do your own due diligence. Second, everybody has an opinion. That's why it's called an opinion. And at the end of the day, no one knows what's going to happen until we see it happen. And once we see it happen, we're all going to say, well, hindsight is 20/20. And third, one thing you want to keep in mind is just because we're in a bubble doesn't mean it's going to pop tomorrow. A bubble can pop tomorrow, next month, next year, or even in a decade. No one can predict that. And there's a lot of money to be made during bubbles. You can make a lot of money on the way up, and when it crashes, that's another great time to come in and buy. If you've ever read the book The Richest Man in Babylon, there was a line in the book that really stuck with me. It said something like, "Do not trust a brick maker to give you advice on how to find the best jewels. Trust a brick maker on how to make bricks, and trust a jewel person on how to find the best jewels." The whole idea behind this is everybody has an opinion, and especially when it comes to money, everybody's gonna have an opinion on how you should spend your money. But this is where you gotta be a little bit smart with your money, and you gotta be the one to decide what's a good decision for your money, and not let everybody else, not these brick makers, people that are not necessarily financial experts, tell you how to use your money. That's why I always say, I am just a random guy on YouTube. Make sure you own due diligence, because what's good for me might not be good for you. We're entering a very unique and kind of a strange and uncharted territory in the investment world because we have a whole lot of new retail traders, brand new investors that are entering the market. That's great news. But that also means we have a lot of opinions of people that might not really understand how investing works, especially over the long run. And so now, especially when you're a new trader, you might be talking to your friends about where to put your money and what's going on and what's hot. And you really got to understand, who are you getting your advice from? I'll be in chat groups with my friends, and people will be chatting with one another about talking about why they're buying GameStop or AMC or whatever hot stock is trending, Tesla. And then someone else will say, "Oh wow, that's a really good idea. Let me jump in and buy it right now." And so now you have this other people that are buying GameStop, AMC, Tesla, whatever stocks you want to talk about. And they're buying it not because they've done their own research, not because they believe in the company, not because they understand the fundamentals or the technicals, but just because their friend, who supposedly made a lot of money over the last year, has made good money and they want to do whatever they did. And so they're following this person's advice. But it's really hard to differentiate good information from bad information when you're in a bull market, which is when the market is going up, because even if you have bad advice, you're still going to make money. And so everybody looks like a financial genius when the market is going up, because even if you make a bad investing decision, your investment still went up. And so everybody thinks they're a financial genius when the market's going up. But the real test of who's good and who's not is what happens when the market pulls back. When the market moves back and people start losing their shirts, and we know this will happen, it's not a matter of if, it's a matter of when, because the market is cyclical. And this is not just the stock market, we're talking about all asset prices. All asset prices, stocks, real estate, gold, they all move up and then they all move down. And we don't know how long these cycles are gonna last, but it's this boom and bust cycle that happens in every asset class. And so the real test of who's good and who's not. It's not just who's making money when things are going up, because anybody can make money when things are going up. The real test is what happened when things turn around. Because if you see your portfolio cut by 50% and now you panic sell and now you lose everything and you lost all the gains that you had to begin with, well, that's not so good. But if all you've seen was a growing stock market, because you came in and you bought when things were bad, which is great news. I'm very happy you did that. If you came in and you bought when things were bad and you rode the market up and everything you buy and everything you touch is going up, well, it seems like you're doing great. But you gotta understand that nothing can go straight up forever. So this is where I wanna give you a little bit of cautionary advice before I get into what I think is going on. No market can go straight up forever. And so if you've been investing your money and all you see is green because you keep making great investment decisions and people keep listening to you, or you keep listening to someone else's advice and all this advice keeps making you so much money, that's great. I'm happy you're seeing great returns. But just remember that nothing can go straight up forever, so don't be greedy. Investing is the path to wealth. So I want you to invest as much money as possible, but at the same time, never invest more money than you're comfortable losing. If things go wrong and the market pulls back and you have this highly leveraged portfolio and your portfolio is cut in half, and now not only did you lose everything, but you owe money to your broker and you don't have the money to cover that cost, now you're gonna be in a very tough situation. Warren Buffett says it the best. In the short term, the stock market is a voting machine. And in the long term, the stock market is a weighing machine. That means in the short term, yeah, hot stocks might take off even if they're not making any money just because they're popular and everybody wants to own a piece of that, and you might be making a lot of money because everybody wants to get in on this hot stock. But over the long run, if this is not a sound company, then you're gonna be the one losing money, because over the long run, the stock market is a weighing machine. What that means is companies that are actually strong and that have real solid fundamentals. These are the companies that will continue to go up even as things go bad, and even if they go down, they will continue to go up after that, while the companies that were overvalued won't, because people won't want to own that anymore because they realize that this company isn't really worth that much. The reason I'm saying this is not just in case somebody comes up to you in the gym and tells you where to invest your money. It's because we're kind of in this world where everybody is an expert, because anytime the market goes up, everybody becomes a financial expert. And so your friends, your family, they might be telling you what to do with your money because they made so much money in the last year. And it's the same thing with social media. Everybody on social media, people who made their first $10,000 or $100,000 think they're a financial genius. And it was very easy to come out and talk about it on podcasts or Instagram or YouTube. And this is where you got to be cautious. Not everybody's telling you to do your own due diligence. So this is where I want to tell you, make sure you do your own due diligence and don't just blindly listen to any random person on the internet. You got to be smart here and understand that nothing can go straight up forever. We do have real fundamental issues in our economy. Like all this money printing is gonna cause devaluation of our dollar. At the same time, we have an unemployment rate which is still very high. We have millions of people out of a job. We have tons of businesses that are no longer there. And so we have real fundamental issues. And this is going to cause issues for years into the future, which makes investing your money even more attractive now than before. But on the flip side of things, we have a lot of people investing their money without necessarily knowing why or what they're investing in. And we also have the highest amount of debt in the market than ever before, because we're seeing the highest amount of margin trading than ever. And at the same time, we also have insanely low interest rates. And so you have a lot of people that are borrowing money and then they're just throwing it in the market because they think, well, if I keep my money in the bank, I'm going to get no returns. But if I can just borrow money at 3 or 4% and I can grow my money at 7%, well, now I get to keep the spread. And so you have a lot of cheap money that's being created that people are borrowing, that they're just throwing into the market. And that's good when things are going up. But when things start coming down, cheap debt and a lot of greed is a very bad combination. This is where, again, your due diligence is so important, because part of that due diligence is knowing what your investment strategy is. Because for a lot of people, their investment strategy is, let me throw my money in the next hot stock and hope I can double my money and sell it whenever I think I'm at the top. But that's not a real strategy. And when that's your mindset, especially when you're investing in a stock market that's so emotional like we're seeing right now, you're going to be the first one to lose everything when the market goes down, because you're going to think, oh my God, I'm going to sell my stock when I'm at the top. But you can never predict when the top is. And then things turn around and you're like, oh, that's just a little correction. And then before you know it, you're in the red, and now you have to panic sell. And when that happens, the market goes down even more. So if you're a trader, you got to have your risk parameters in place. When do you sell? What is your goal when it comes to selling? And if things start to come down, at which point do you start to sell? And how much do you sell at what price points? These are things you got to know before you even start buying. It's the same thing for those of you that are long-term investors. If you're a long-term investor and you're investing in a company because you believe in it and you understand the fundamentals and you think this company is going to continue to thrive for the next decades, and you invest in this company and it gets cut in half, you should not be the one panic selling because you're investing for the long term. You believe in the value of this company. The only thing you should be doing if the market crashes is buying more. And so you got to have the strategy and you got to understand why you're buying and then stick to that strategy, because if you start flip-flopping and you tell yourself, yeah, I'm investing in this company for the long term, and then the stock is cut in half, and then you panic sell because you see the stock going down even though the company doesn't have real fundamental issues, then you are flip-flopping strategies and now you're the one losing. And this is what happens to so many people when things go wrong. A company stock price doesn't tell you how good a company is doing. I mean, it should, and sometimes it does, but sometimes it doesn't. And so you got to understand that sometimes you're going to see a big disconnect between a company's stock price and a company. And if you're a long-term investor and this company's stock prices come down, but the company is still the same, you should not be the one panic selling. The people that make the most money in the market are not the people that are emotional investors. It's not the people that are just trying to find the next hot stock. It is the people that understand what their goals are and they are financially investing their money, whether it's trading their money for the short term or investing their money for the long term, because they make financial decisions, not emotional ones. And so if you want to be successful through the long term in the market, you got to understand what your goals are and you got to set these parameters for yourself, because when things are going up, hey, it's easy to make money and it's easy to think you're a financial genius. But when things turn around, because things will eventually turn around, when, I have no idea, but when things do turn around, you don't want to be the one holding the hot potato and then not knowing what to do, and then you lose all of your gains. And if you're looking for an easy way to get educated, that way you can make smart financial decisions, well, we talk about this stuff every single week on our YouTube channel. So if you haven't subscribed to our YouTube channel yet, make sure you do that. If you enjoyed this video, here's a video on investing that I think you'll love. And while you're at it, download a free guide on investing your money in the stock market. And as always, keep hustling. But in the long run, what really affects the stock's price is its fundamentals. That's how much money is the company making, how are their profits looking, are their revenues growing, are their profits growing, how is the management, and are they innovating for the future? So these are the things that really affect the company's stock price over the long term.